The current investment environment is fraught with contradictions and challenges. Traditional asset classes are exhibiting unusual and elevated risk profiles, while historically effective diversification strategies appear to be failing. This creates an urgent need for alternative solutions. One of the key market valuation metrics is the cyclically adjusted price-to-earnings, CAPE ratio, also known as the Shiller P/E ratio. This metric smooths the average inflation-adjusted earnings over the past decade, providing a more robust valuation signal than the standard P/E ratio. By October 2025, the Shiller P/E ratio for the S&P 500 had soared to a staggering 39.51. This value is not only significantly higher than its historical arithmetic average of approximately 17.6, a significant 119% increase, but also places the current market at the 99th percentile of its historical valuation range. Historically, the only time this ratio has been significantly higher than its current level was in December 1999, at the peak of the dot-com bubble. That bubble burst ushered in a 2-year bear market that saw a 49% decline. Historical data has repeatedly demonstrated a strong negative correlation between the initial Shiller P/E ratio and average returns over the next 10 to 20 years. In other words, when valuations are high, future long-term returns tend to be low. Current valuations mean that investors are paying a premium for stocks typically seen only during periods of speculative frenzy, suggesting a potential significant disconnect between market prices and long-term economic realities. These are not merely high valuations, but historically extreme valuations, signaling that the market's margin of safety has become extremely thin. Therefore, broad equity indices are not a low-risk option, but rather a major source of risk in today's portfolios. Gold, a traditional safe haven asset, has performed exceptionally well over the past few years. Since its low of approximately $1,633 per ounce in October 2022, the price of gold has soared to over $4,091 per ounce in October 2025, a roughly 150% increase. A Morgan Stanley report also indicates that the price of gold has increased 2.5 times since October 2022. This strong rally was primarily driven by expectations of Fed rate cuts, a weakening dollar, and safe haven demand stemming from geopolitical uncertainty. However, while gold has perfectly fulfilled its role as a hedge against uncertainty over the past 2 years, its price has risen so quickly and so high that many positive factors, such as the start of the Fed's rate-cutting cycle, may already be fully priced in. An asset that has appreciated over 150% in 3 years is hardly statistically likely to be the best-performing safe haven asset over the next 3 years. Its role may be shifting from an active hedge to a crowded trade. After such a massive rally, the principle of mean reversion suggests a growing likelihood of consolidation or a pullback. Therefore, it takes tremendous courage to continue to maintain gold as a key component of a portfolio. Regarding cryptocurrencies, on October 10th to 11th, 2025, the cryptocurrency market experienced its worst flash crash in history. Triggered by the tariffs announced by U.S. President Trump, the event resulted in the liquidation of over $19 billion in leveraged positions. Bitcoin prices fell by approximately 15%, Ethereum by approximately 21%, and many altcoins plummeted by 50%, 70%, or even more as market makers withdrew liquidity under pressure. This incident was more than just a price drop. It exposed systemic vulnerabilities in the crypto market structure. The sudden evaporation of altcoin liquidity demonstrated that their value was not supported by genuine investor demand, but rather relied on a thin layer of market-making services that could collapse under pressure. The large-scale leveraged liquidations demonstrated that the market remains highly speculative. This incident severely undermined investor confidence in cryptocurrencies and slowed Bitcoin's formal establishment as digital gold. A true safe haven asset should see inflows during periods of macroeconomic stress, not undergo a catastrophic structural collapse. This flash crash demonstrates that the underlying infrastructure of the crypto market is not yet mature enough to withstand systemic shocks, and its trading structure requires further strengthening. Therefore, it also represents an ideal low-risk asset. Let's look at bonds. According to conventional financial theory, when central banks cut interest rates, long-term bond prices typically rise due to lower yields. However, Since the Federal Reserve began cutting interest rates in September 2025, a counterintuitive market phenomenon has occurred. Despite a decline in short-term interest rates, long-term Treasury yields have remained stubbornly high, with 30-year Treasury yields approaching 5% at one point. The yield spread between 5-year and 30-year bonds has widened to its highest level since 2021, far from where prices were just a few years ago. The failure of long-term bonds to rebound as expected signals a profound market shift. Investors are no longer solely focused on the Fed's short-term policy rate. They are demanding a higher term premium to compensate for the long-term uncertainty brought about by persistent inflation risks and large government deficits. The so-called bond vigilantes appear to have resurfaced. This phenomenon undermines the fundamental premise of the traditional 60-40 portfolio: 60% stocks, 40% bonds. That bonds should serve as a reliable hedge against stock declines. If bonds and stocks can decline simultaneously, the traditional definition of a safe asset is upended. This means that long-term bonds have lost some of their risk-free characteristics in the current macroeconomic environment and are no longer a reliable portfolio diversifier. One of the greatest uncertainties facing the market today stems from the potential political influence on monetary policy. The current administration has made it clear that it will appoint a new Federal Reserve chair in 2026 who will be more inclined toward aggressive rate cuts. Its stated goal is to significantly reduce the federal funds rate, potentially leading to negative real interest rates. This political pressure on the Fed's independence introduces a significant new variable into the market. Even more worryingly, if the economy falls into a recession, the government is likely to repeat the 2020 to 2021 scenario and implement another round of large-scale fiscal stimulus. Both politically motivated excessive rate cuts and recession-fighting fiscal expansion are highly inflationary. This stagflation combination of weak growth, which prompted the stimulus, and high inflation, its consequence, poses the greatest threat to wealth, eroding the value of both stocks and bonds. We are shifting from a world dominated by predictable business cycles to one dominated by unpredictable policy decisions. The nature of risk has shifted from cyclical to political and structural. This structural shift necessitates the search for a new type of portfolio hedging tool, one specifically designed to protect against policy-driven inflation and volatility. To build a strategy for this new environment, we first need to understand a fundamental tool: U.S. Treasury Inflation-Protected Securities, TIPS. They provide investors with a protection mechanism directly tied to official inflation data. We will explain their mechanisms and features in the next issue, which can provide an effective strategic tool for navigating this complex landscape. TIPS are debt securities issued by the U.S. government. Unlike regular Treasury bonds, their core characteristic is that the principal value adjusts based on changes in the Consumer Price Index, CPI. While the coupon rate on TIPS is fixed, the interest payments fluctuate because they are calculated based on the new inflation-adjusted principal. This means that during periods of inflation, investors not only see their principal grow, but also receive a corresponding increase in interest. A key protection mechanism is that even in times of deflation, i.e., a negative CPI, the principal repayment at maturity of TIPS will never be less than the initial par value, providing investors with a capital floor. This design makes TIPS the most direct and transparent way for investors to ensure their capital's purchasing power keeps pace with the official cost of living. For TIPS investors, the most important concept is the break-even inflation rate. This isn't the yield on TIPS itself, but rather the yield differential between TIPS and regular Treasury bonds of the same maturity. This differential represents the market's consensus expectation of the average annual inflation rate over the bond's life. The logic behind the investment decision is clear. If the actual annual CPI in the future is higher than the break-even inflation rate at the time of TIPS purchase, TIPS investors will see a higher total return than regular Treasury bond investors. Conversely, if actual inflation is lower than that level, holding regular Treasury bonds will be more cost-effective. This fundamentally transforms investing in TIPS from a passive hedge to an active investment decision. Investors who buy TIPS are effectively betting that market inflation expectations are too low. Profits derive from the gap between market expectations, the break-even rate, and future reality, the actual CPI. Here's a real-world example that perfectly illustrates this mechanism. In October 2020, when a 5-year TIPS was issued, the market's break-even inflation rate was just 1.65%. This suggests that the market at the time widely believed that the next 5 years would be a low-inflation environment. However, over the following 5 years, due to massive fiscal stimulus and supply chain disruptions, the actual annual CPI reached a high of 4.43%. This significant gap between expectations and reality led to a striking divergence in the returns of two types of bonds. TIPS, its initial negative real yield, minus 1.32%, combined with an annualized inflation compensation of 4.43%, ultimately achieved an annualized return of 3.11%, with a 5-year total return of 16.63%. Treasury bonds, they fully delivered on their initial promise, with an annualized return of 0.33% and a 5-year total return of only 1.64%. As shown in the table below, TIPS's returns were more than 10 times those of Treasury bonds over the same period. This case study strongly demonstrates that the market's inflation forecasts, i.e. break-even rates, are not always correct. In 2020, the market failed to foresee the inflationary consequences of government actions. An investor who simply believed that massive government stimulus would lead to higher inflation than the market expected could earn returns far exceeding those of safe Treasury bonds. This provides a powerful historical precedent for evaluating the current market environment. While TIPS offer an effective hedge against inflation, they are not without risk. Like all bonds, TIPS are subject to duration risk. This means that if real interest rates rise, the market price of TIPS will decline, even if they still provide inflation protection. For example, suppose inflation rises to 5%, but the Federal Reserve raises interest rates sharply to combat this inflation, causing real yields to rise by 1%. In this scenario, the inflation-compensated return on the TIPS principal may be offset by the decline in its market price due to rising interest rates. This reveals a key nuance. TIPS protect investors against inflation, but they do not necessarily protect them against the actions taken by the Federal Reserve to combat inflation, i.e., rate hikes. This makes TIPS an imperfect hedge in a stagflationary environment, where central banks may be forced to tighten monetary policy amidst a weakening economy. This weakness is precisely what more advanced strategies must address. Given the limitations of TIPS in certain environments, the market requires a more sophisticated tool. The IVOL, Quadratic Interest Rate Volatility and Inflation Hedge ETF, was designed to address this need, with a unique structure designed to overcome the weaknesses of investing in TIPS alone. IVOL is an actively managed ETF whose core strategy is to invest in a combination of TIPS and long options tied to the shape of the interest rate yield curve. It does not passively hold TIPS. The fund manager actively manages its options portfolio, typically investing less than 20 to 25% of the fund's assets in option premiums. This structure makes it a hybrid instrument, consisting of two components: a base of TIPS, providing inflation protection and stable income, another portfolio of speculative options with potentially high returns, serving as a tail risk hedge. IVOL's key differentiator lies in its holdings of over-the-counter, OTC, interest rate options. These aren't stock options, but rather options based on the spread between different points on the interest rate yield curve. For example, the spread between the 2-year rate and the 10-year rate. These options are designed to increase in value under two primary circumstances. 1. A steepening yield curve, when the spread between long-term and short-term rates widens. This can be caused by rising long-term rates, falling short-term rates, or both. 2. Increased interest rate volatility. When bond markets become more volatile and uncertain, the prices of these options, i.e., their implied volatility, increase. This design is quite ingenious. As mentioned earlier, the primary risk facing TIPS is rising real interest rates. A scenario in which long-term interest rates rise sharply would precisely lead to a steepening yield curve and/or a surge in volatility. Therefore, IVOL's options portfolio is designed to generate profits in an environment where its core TIPS holdings face downward price pressure due to duration risk. This constitutes an elegant, self-consistent internal hedging mechanism. These options are not just for speculation. They are a key tool for managing the fund's own portfolio risk. So, when will IVOL perform well? According to the fund's prospectus and strategy document, IVOL is designed to outperform in several specific environments. A stagflationary environments. The combination of economic weakness, which prompts the Federal Reserve to lower short-term interest rates, and persistent inflation, which keeps long-term interest rates high, will lead to a sharp steepening of the yield curve, which is highly beneficial for options portfolios. A market shocks and crisis alpha. Historically, large equity market sell-offs have been associated with spikes in fixed income market volatility. During periods of market panic, IVOL's long volatility position is expected to increase in value, providing a potential hedge that is uncorrelated with stocks and bonds. A normalization of inflation expectations. These options function similarly to options that hold inflation expectations. If the market's currently low inflation expectations, i.e., the break-even rate, begin to converge toward higher levels felt by consumers, this would push long-term interest rates higher and steepen the curve. Let's summarize the key drivers of IVOL's performance. There are 5 positive factors. 1. Rising TIPS bond prices. 2. Increased interest rate volatility. 3. Expectations of further Fed rate cuts, lower short-term interest rates. 4. Rising long-term interest rates. 5. A steepening yield curve. 1 negative factor. A flattening or inverted yield curve. The above summary provides investors with a quick reference, clearly showing which economic environments are favorable or unfavorable for the fund. The following will synthesize the preceding analysis, integrating the current market environment, the TIPS mechanism, and IVOL strategy to provide investors with a clear and actionable conclusion. The core of the entire investment thesis lies in comparing the discrepancy between market pricing and other credible inflation forecasts. A market pricing break-even rate, the current 5-year break-even inflation rate is 2.5%. This is the level the market has already priced in. Expert/model forecasts. The Cleveland Fed's model projects average inflation of 2.32% over the next 5 years. The Federal Open Market Committee, FOMC's long-term target is 2%. These forecasts are broadly consistent with or lower than market pricing. A consumer surveys. The New York Fed's Consumer Expectations Survey shows a median 5-year inflation expectation of 3%. Meanwhile, the University of Michigan's Consumer Survey shows a 5-year inflation expectation of 3.7%. These divergences reveal core contradictions and opportunities. The logic behind investing in IVOL rests on the belief that consumers, who are on the front lines of price fluctuations, can be more accurate in predicting future inflation than financial markets and economic models. The historical case of the 2020 to 2025 period has demonstrated that the market can make significant mistakes. The current divergence in forecasts presents a similar opportunity. If you believe that structural forces such as fiscal policy and political pressure will keep inflation closer to the level felt by consumers, then the current market pricing of inflation hedges is irrational. Nevertheless, no investment is foolproof. The main risks to IVOL are precisely the opposite of the drivers of its success. At the cost of tranquility, premium loss. The greatest risk is a stable, low-volatility macroeconomic environment in which the yield curve remains flat or inverted. In this soft landing scenario, the options held by IVOL would continue to lose value, time decay, as they approach expiration, dragging down the overall performance of the TIPS portfolio. This can be thought of as the insurance premium investors pay for protection. At the trap of a flattening curve, if the Federal Reserve aggressively raises interest rates to curb inflation, causing short-term rates to surge while long-term rates remain stable, this will lead to a flattening of the yield curve, resulting in losses for the option position. A counterparty and cost risk. IVOL's options are traded over the counter, which introduces counterparty risk, i.e., the risk of default by the other party to the transaction, although this risk is typically mitigated through collateral. Furthermore, the fund's relatively high management fee, approximately 1%, compared to passive ETFs presents a direct performance barrier. Thus, it is important to understand that IVOL is a hedge, not a panacea. Its value is conditional, and it does not perform well in all market conditions. It is specifically designed to excel during periods of stress, volatility, and stagflation. Investors must understand that they are paying a premium for this protection, which can become a drag in calm markets. In summary, the current market landscape presents a complex landscape. Equity valuations are at historical extremes. The commodity rally may be showing signs of fatigue, cryptocurrencies are exposing structural vulnerabilities, and traditional fixed income assets are losing their relevance as reliable hedges. Looking ahead, a stagflationary environment driven by policy uncertainty and a new era of fiscal dominance presents the primary risk to portfolios. Pure TIPS offer some protection but are vulnerable to rising real interest rates. TIPS&IVOL's hybrid structure is designed to address this vulnerability, combining the underlying protection of TIPS with an option strategy to hedge duration risk and profit from the volatility and yield curve steepening characteristic of a stagflationary shock. While IVOL carries its own risks, particularly its performance drag in a benign economic environment, it represents a sophisticated and targeted tool for this particular macro moment. It's not a risk-free asset, but it may be one of the least correlated and most effective hedges against the major structural risks threatening diversified portfolios today. It's suitable for investors who believe the future won't simply repeat the past, and who want to ensure their portfolios accordingly. The above is for informational purposes only and does not constitute investment advice. Thank you for your attention and company.